My name is Kevin Kalyan, and I run multiple businesses generating over 8 figures annually. I'm the owner and broker of Gold Star Premier Properties, the owner of Gold Star Floors. I run a fix and flip and new construction and development business, and I'm also in the financing industry. What I don't like to do is brag. I like to work. That's why they call me the Silent Mogul. Financial literacy is very important. That's why on today's episode, I'm very excited to have my friend with me, Louis Soriano, who's a certified financial planner. Lou, thank you for being here with us today. I'm glad to have you.
And thanks for having me on the show. I appreciate it.
It's great, my friend. So just for those that don't know you, can you just tell the audience who you are?
Absolutely. So my name is Louis Soriano. As Kevin mentioned, I'm a certified financial planner. And besides being a certified financial planner, first and foremost, I am a dad of 3 children. I have twin daughters, Lauren and Celine, 21 years old, students at Oneonta. And my son is Justin Soriano. He's a realtor here on Long Island on the O'Neill team. And I'm also married for 28 years, something we were briefly talking about before we started the show here.
Lou, you had me fooled. I'm sorry to put you on the spot, but just tell the audience how old you are. Because you do not look your age, my friend.
Thank you for that. I'm 53 years old, and I cut my hair a little shorter, so that's why I might be faking some people out. I keep the hair short and keep the grays out of the way.
So what's the secret?
The secret is honestly balance. I try to have some balance in my life, in every aspect of my life. And that's why I mentioned my family. They're like the core. I'm a big believer in trying to maintain balance. It's not easy, right? I find that people who are ultra successful are missing that in some respects. So they're very successful financially, but maybe, divorced 2-3 times over.
Yep.
And there are some people that, that's all they focus on, and they don't do things for themselves, whether it's concerning their health or their finances. So I try. Not always successful in doing so, but that's always been a goal of mine.
Lou, let me just say this and get it out the way. I've been following you for a while, and my particular age group and a lot of people that I talk to aren't fiscally responsible, if that's how you want to phrase it, right? So I followed you on social media for a while, and I learned a lot from the content that you were putting out, and I felt that if I learned from you, my audience can learn from you. So right off the bat, I just want to understand in your mind frame, why do people in my age group in particular, why are so many of them in debt?
Well, first off, your demo is an amazing demographic. This young generation is smarter. They are more knowledgeable. They believe in themselves more so than my generation did. And but with that comes other things, right? Such as college debt. Unfortunately, the expenses associated with a college education now are astronomical. And it's very difficult to avoid accumulating debt if you want a college education for most people. So it starts there. And I think also consumerism. Listen, we're on social media. Everybody's viewing other people, and we try to keep up with the Joneses.
Yeah.
And younger demo more so. And it's actually a big topic in the news lately too, how social media affects young people. And I think that's another reason why we consume. And listen, we're all Americans. We love
to consume.
We love to consume. We love our nice things and clothes and cars and things like that. But I think those two collectively are the main reason why people accumulate so much debt at a young age, and they get used to it. And as long as they're able to make the payment, they feel like they're okay.
But that's the problem, though. Not all of them can make the payment. So, for example, if you're making X amount a month as a salaried employee, say, for example, you're making $5,000 a month, but you have a car note that's $2,500 a month, then you have your living expenses, your rent, you have your wife or girlfriend.
And this $5,000 you're speaking of, is that pre or post-tax? Because
that's pre-tax.
Okay, yeah, there you go. So that's my point. That's really much lower than the $5,000. Gross is $5,000 after taxes. Uncle Sam gets his piece, 20-30%. It's tough.
We're spending more than we're making, and that's
absolutely,
that's always going to lead us down a road of of hardship, right?
Absolutely.
So is there a particular investment philosophy that you follow, or how would you answer that question?
So as far as investment philosophy, it differs for everyone, and it depends on, and one thing I like to do is cater it towards the individual, right? So it's very hard to answer a question like that for most people because it's hard to give generic advice. But I will say that it's important to invest. How about that? So if you get paid, one of the first things you should do is set aside some money to invest for yourself or in yourself if you're self-employed. So I think that's very important to do. And my philosophy is to diversify. I'm a big proponent of asset allocation. If you're investing in mutual funds or in the market, just don't invest in one sector of the market. Many sectors should be leveraged, as well as investing internationally and in different asset classes. So I'll leave it there. Investing is not using, in my opinion, using the apps that are out there now, the Robin Hoods and so forth, and just buying and selling stock, or you heard your buddy bought something and you're going to try to double up in a week.
Because then you're a hobbyist. You're not really an intelligent investor.
It's not investing at all, my friend. It's taking
gambling.
a shot. It's gambling. There you go.
just go to the casino and put 20 on red.
Your odds might be better in the casino.
Yeah. So I mean, I see it every day where they download this app, this new app that just came out. Somebody puts on social media, X, Y, and Z is the new best thing. They drop 1,000 on it before they even blink. They don't even know the history of the stock or the crypto or
they're just going on a recommendation that they may have heard from somebody they know personally.
Not even. Sometimes they just see a post.
And sometimes they just see a post.
Yeah.
I see more of that on Twitter more and more now, where, and these guys are getting quite the following based on maybe another investment that they might have recommended. And now they have this huge following, and people are just buying stuff based on their recommendation. I wouldn't advise doing that.
So what do you advise? And before we get to what you advise, can you give us a backstory on who you are? What is a certified financial planner?
Yeah, so a certified financial planner, unfortunately, sometimes it's confused with a CPA, right? CFP, there's a lot of designations out there. So for those listening, a CPA is a certified public accountant, and they specialize in accounting. A CFP is a little different. Certified financial planners typically are familiar, and I say familiar because every CFP is a little different, but we are trained to cover really 5 categories, and that is investments, insurance, taxation, estate planning, and ethics. And when I say ethics, as CFPs, we hold ourselves to be fiduciaries for our clients. So when you speak with a certified financial planner, they kind of cover the gamut of all aspects of financial planning, whereas a CPA might just cover the taxation. You have great insurance professionals out there. They might just cover
a small sector.
Insurance. And same thing with an investment advisor, or what typically was referred to as like a stockbroker. They're just talking about just investments. They don't know how those investments may impact your taxes and estate planning. Yeah, so CFPs try to encompass everything, kind of a one-stop shop.
Got it. I heard you say just now fiduciary. Can you explain to us exactly what that is?
Yeah, so as a fiduciary, you are putting your client's interests before yours.
Sounds simple.
Sounds easy enough. Not always so easy.
Yeah.
Because depending on how you're compensated and when you're working with other professionals, I'll just put it out there, whether it's a financial professional, an insurance agent, a realtor, whatever the case might be, if they're compensated solely on commission, sometimes they have an incentive to advise you to go in one direction over another because it might be in their best interest, not necessarily yours.
So Lou, I felt that a CFP, there was always this misconception that only the wealthy could afford a certified financial planner, right? Just talking to you, knowing you, seeing the type of clientele that you have, I know that that's not the case.
Absolutely
You may
not.
have some clients that are wealthy and better off than others, but you may have your average Joe just making a normal wage, honest living. who can come to you for advice to try to better themselves and increase their
Absolutely.
future financial portfolio, right?
Yep.
So with that being said, if somebody did want to call you up and retain your services, what are your typical fees, or what does a CFP cost?
Okay, so that's an excellent question. And I have to tell you, I've been on a lot of podcasts. These are great questions.
Appreciate
because most times, it's just talking about, oh, he's a financial planner, and we talk about topics of the day.
Yeah.
But the reality is that CFP, and a lot of financial professionals, by the way, could be leveraged to your advantage. You should not think that you need, and that's the big misconception that I'd like to clear up, and thank you for asking the question, is you do not need a lump sum of money or a large sum of money to work with a CFP, or need to be wealthy to work with a CFP. In fact, you should work with a CFP or other financial professionals before you accumulate money, because you could get there a lot quicker. So with that, and to answer your question about how we're compensated, there's really two ways financial advisors are typically compensated, including CFPs, and that's either by commission or fee-based.
Okay.
Commission is clearly, a commission, right? You invest $1,000 and there's a 5% commission. I tend not to use that business model. I like the fee-based a little better, although I do some commission work depending on the client and the goal. Fee-based is the financial planner is compensated a percentage, typically 1 to 1.5% of the assets under management, and that's an ongoing fee. So in the case of a commission, for example, you give a financial planner $10,000, I'll just use an easy number, and they charge 5%, that's the commission.
Okay.
Whereas if you are in a fee-based model, you're really only paying 1.5% each year.
Okay.
So you don't
1.5% of the
assets under management.
Okay.
So if it was 10,000, 1% of that, is the $100, right? I'm using hypothetically,
Yeah.
or $150. Obviously, as the numbers get larger, it's the same fee percentage-wise, but what they're compensated is higher.
Understood.
So there's two routes basically. It's a commission model or a fee-based model, and you got to ask these type of questions. It's important that, and I'm glad you brought it up, because you should know how your advisor is compensated. Because some advisors, if you're just compensated on commission, you will hear from them all the way up to the point of the investment, and then you might not hear from them ever again. Whereas with fee-based, you want to continue to service that client because you are paid a fee each year.
And you also want the consumer or the client, so to speak, to feel comfortable investing in you, right? You want, obviously, it has to make sense for both sides,
100%.
right? I'm putting my money because I want a return on it.
Yep.
You're advising me because you have a family to feed, right? But also, it's a partnership between you
Right.
and I. So I want to make sure that if I'm investing in you, you have my best interests at heart.
Exactly.
And I'll compensate you whatever your fee would be. It's just a two-way street, right?
Absolutely. And that's part of the fiduciary thing I was describing a little earlier too. So all this should be disclosed too. That's another thing. So even you should be asking these type of questions if you're working with a financial professional. But another key is if you're working with a financial professional and maybe they're evasive about the fee or they don't clearly disclose the fee, you should ask some more questions.
Yeah, I would think that it would be transparent and laid out in black and white.
Not always, because some of these accounts, especially if you're talking about like a rollover account, a situation where you're rolling over a 401k account that you might have had with a previous employer to an IRA. There's a lot of forms and documents. There's transfer forms, there's the account application. So you're in real estate, it's sort of like signing a mortgage.
Yeah.
You're doing a lot of signing, but you're not
Really reading the
necessarily
documents.
reading every document, and that's why you want to hire a professional who is doing that and is explaining to you what exactly it is that you're signing and why, and that's why you're compensating these professionals.
Yeah, well, on the real estate side, you hope that you've hired a competent attorney
100%.
to read that information and tell you the pros and cons of everything that you're signing. And On the investment side, like you said, that's why people come to you. That's why you've developed such a great book of business. It's because of your integrity and the fact that you walk them through each phase of the process.
Yep.
So I would highly recommend you to everybody that's looking at this podcast right now, just off the simple fact that, you know, you're a fiduciary, as you said, right? You're about the client's interests.
Absolutely.
You're about having a transparent relationship, whether it's good or bad. With investment, we all know there's always risk involved.
Exactly, but there again is where you have a fiduciary responsibility to explain
the risk
and
involved.
set that expectation,
absolutely.
in advance.
So you don't really come across as somebody that I would have pegged to be so knowledgeable about the financial space. Like, I would have thought that you would have been a bodybuilder or a boxer or something like that.
No.
Or a wrestler, who knows, right? How did you get into this particular field?
Man, let me tell you, it's a long story, and I don't want to bore your listeners here, but I'm a Brooklyn guy in Brentwood, so that's why maybe
I'm a Queens native. So
okay. Red Hook in Carroll Gardens, Brooklyn originally, Brentwood, Long Island, and I now reside in Smithtown. But I am the average guy, as you say, and then I got nerdy over time by getting into this business, and it was my uncle Victor. Actually, I was working as a biomedical engineer.
Oh wow,
and
that's a surprise right now too.
Yep. So, fun fact: I was an engineer, biomedical engineer, and that's when I started to invest because my first job had a 401k plan, and I had a boss who was investing in the market and was working through a broker. And I always had an interest in this because when the market crashed in 1987, I was young. My mom rode the train back and forth to the city to work, and all of her, all the commuters that she worked with and her friends, they were all like devastated. It was big news in 1987. I'm dating myself. But I remember that being big news. So when I had a couple of bucks to invest myself, I wanted to learn more about it. So those two things took place, and I had an uncle who was an accountant, and when he prepared my taxes, I was giving him all these 1099s for some of the mutual funds I was investing in and stocks I was investing in, and he suggested that I get licensed and learn the business because he saw I had such an interest in it, and that's what happened. And I liked the idea of cutting out, the middleman. At that time, commissions were very high. Unlike now, I kind of like the environment now where you have access to research on your cell phone and understand some of these things. Back then, that wasn't the case. There was always a stockbroker involved. But that's how I got started. So I started investing on my own. My uncle, who was an accountant, saw that I took an interest. He took an interest in me, and I got licensed.
So you took an organic approach, so to speak.
That is the perfect word, is organic, because I started with my own, managing my own account and preparing my own taxes. And then little by little, people saw I was into this thing, and it was more than a hobby. And I started helping friends and family, and then they referred me, and then it became a business.
I noticed you said that at that time the environment was changing. And you and I discussed this briefly, that our current financial environment is changing. The rules, the regulations, the tax implications of certain things that we use day to day is changing. And for me specifically, I get paid a lot through Venmo or Zelle or QuickPay. You as well, right?
For tax returns, yes.
What are the current rules that are in place, and what are some of the changes that you see are going to take place within the next 12 to 24 months?
Again, this guy, he asks great questions.
I appreciate that. Thank you.
So there's a lot in the news now, and a lot of people are actually asking me about, what's this new rule that if I make more than $600 using, I'll call it my cash apps, and that could be anything like Venmo, Zelle, PayPal, Cash App, these peer-to-peer applications. Am I going to get taxed if I move $600 or if I get $600? So up front, I want to say, unless you're using it for business, it's no. So if you're using these applications personally and you're reimbursing somebody for dinner, or you're sharing rent with somebody, or you receive money as a gift, this is not going to be taxable. If you are using these applications for goods or services, business, then yeah, it's something to be concerned with. And to answer your question, the current rule is if you make more than $20,000 and 200 transactions, you get a 1099K from the Cash App that you're using, whether it's PayPal, Venmo, Zelle, whichever app you're using. So that's the criteria currently, 2021, and it has been for many years. So this is a long-standing tax law. So $20,000, 200 transactions. The American Rescue Plan Act changed all of that this year in March. They have a new proposal where if you make more than $600 a year, regardless of how many transactions, so there's two thresholds that have been dramatically dropped. The number of transactions has been eliminated, and the threshold has gone from 20,000 to 600.
Which is insane.
Which is insane. Yeah. So needless to say, a lot of people who use these apps, like you and I, are nervous, right? Because it's like, hey, there's going to be a lot more reporting going on.
Another thing to get taxed on.
Another thing to get taxed on. But the reality is, the rule is why $600 is the rule. It's always been the rule. So you're supposed to self-report this, right? Many people do not if they're using these applications. So the IRS and the current administration want to change that to recoup. Listen, there's a lot of money that was given out over the last year or two. And this is a way to collect more tax revenue without raising taxes. It's sort of like wink, wink.
Yeah.
So that's why they're doing it. But there's been such an uproar over this $600, this very low threshold, and the confusion it caused, that just this week they kind of modified this threshold a little bit, and they're going to up it to 10,000 right now. And my expectation is that's the number that will probably stick, the $10,000 number. So as of January 2022, if you're using these applications for business, selling goods or services, you have a business online, like an Amazon store, or you're an Uber driver, anything like this, this is going to come into play, and you should pay attention to it. So the new rule will be, if you have over $10,000 in transactions, these peer-to-peer applications are going to issue a 1099K to you and to the IRS. And the expectation is you're going to report it. Now, you can deduct expenses against that income just as you would any other, but it's just going to be more income that you're going to be required. You are required now, but they're going to make it easier for you to meet that requirement by giving you this 1099.
Well, that's a lot of information, right?
Yeah.
So it's a lot for us to process in terms of what the current rules and regulations are versus what's coming in the future. Mm-hmm. But listen, we're in an ever-changing world, right? So there's going to be new policies, there's going to be new administrations, there's going to be new tax implications. 100%. We just got to deal with it.
We just have to deal with it. And the one thing I'll say, this is not political in any way, you look at the SALT deduction that was taken away. That's the state and local taxes. Mm-hmm. That last administration, basically reduced that to $10,000. And then another administration comes in, they kept it.
Yeah.
And so some of these things, once they enact them, if there's one thing that Democrats and Republicans could agree on, is not changing things too much when it's to their benefit, especially with taxes. So
if it doesn't make dollars, it doesn't make sense, right?
So they usually leave it alone. They complain about, look what he did, look what they did, but they leave it alone. So.
Well, listen, let me say thank you so much for being here, sharing this great information with my audience. As we wrap this up today, if anybody out there wanted to reach out to you, get some advice, whether just a quick consultation or wanted to retain your services, how would they get in contact with you?
So the best way to reach me is you could call me directly, 631-236-5842. That's my direct number. You could also follow me on Instagram, where I provide a lot of content on social media. I have other platforms too on some of the other sites, but I leverage Instagram more than the others. I got to work on it so I could be like my buddy Kevin here and diversify there.
I know, talking about diversify, I know you have a big basketball game coming up. Is there something you want to talk about? I know my friends over at the Real Estate and Chill podcast have a big event coming up. So
they
want to touch on that?
Yes, and thanks for mentioning that. So it's a great cause. This is going to be a nice event. We're raising money for, as of right now, we have over $10,000 that's going to be donated to St. Jude's. So that's the core message that I want to get across. That's really what's the, our motivation behind this, was to donate money to St. Jude's. But we're also going to have fun. If you're following any of these real estate people on Instagram, you'll see that there's a lot of chatter going back and forth.
Yeah.
All in good fun. I hope. We're going to find out on the 27th. The game takes place on October 27th, which is on Wednesday, next Wednesday, and it's going to be at LIU CW Post. If you're looking for tickets, you can go on the Real Estate and Chill podcast, and they'll have a link there. If you use the code CFP, you'll get a discount.
Well, Lou, I'm very happy to hear that you're donating to St. Jude's. It actually has a very close place to my heart. So on behalf of myself and my company, I will be contributing $1,000 towards your your charitable cause, right?
That's awesome. Thank you.
I'm not gonna put it on who's gonna win the game or not, but you have that from me. Awesome. Just want to say thank you. It's actually giving me chills that you guys are doing that. Listen, guys, thank you for joining us in another episode of the Silent Mogul podcast. Don't forget to like, comment, and subscribe. We'll see you on the next episode. Take care.
Thank you.